So what if I told you the secret to getting rich in the stock market wasn't about clever trades or constantly checking your phone or some kind of brilliant timing? What if it was about doing absolutely nothing? I know it sounds completely crazy, but today we're going to dive into a strategy that suggests the most powerful move you can make is to be strategically lazy. This is the coffee can portfolio, and trust me, the story behind it might just change the way you think about building wealth forever. This quote from investment manager Robert G. Kirby, it just perfectly captures the paradox we're exploring here. On the surface, it sounds kind of absurd, right? But behind this simple sentence lies this really profound truth about investing, about our own psychology, and about the hidden power of just being patient. And it's a truth he discovered through a real-life story that totally changed how he saw the market. Okay, so picture this. It's the 1950s, and Kirby is advising a married couple. He's managing the wife's portfolio super carefully, doing all the standard stuff, buying promising stocks, selling them to lock in profits or cut losses. Her portfolio was the very picture of professional management. Meanwhile, the husband was kind of secretly piggybacking on Curly's advice. He made every single buy recommendation, but he never, ever sold a thing. So years go by, the husband passes away, and Kirby gets a call to take a look at his account. And he was just stunned. The portfolio was a mix of some small winners and a bunch of stocks that had gone nowhere. But then he saw it. One investment he'd recommended years and years ago, a little company called Holloyd Photographic, which later became Xerox, had been left completely untouched. That single forgotten stock had grown to be worth over $800,000. Now get this, that one stock was worth more than the wife's entire professionally managed portfolio. And Kirby? Oh, he had sold that very same stock from the wife's account years earlier to lock in what he thought was a nice, small profit. I mean, that's the million-dollar question, isn't it? The husband's portfolio was a total mess by any conventional standard, yet it just crushed the sensible one. This accidental experiment revealed this incredibly powerful investing engine, and it all starts with a really simple idea. So that accidental success story gave birth to a formal strategy, and they called it the coffee can portfolio. The name itself is pretty cool. It comes from the Old West, a time before banks, when people would put their valuables in an actual coffee can and hide it under the mattress. The goal wasn't just to protect it from thieves, but also from their own temptation to dig in and spend it. And that is the core idea right there. You find a selection of excellent companies, you put them in a metaphorical can, and then you lock it for at least 10 years. No trading, no rebalancing, no tinkering whatsoever. You're protecting your best assets from all the market noise and maybe more importantly, from your own worst impulses. So, how does this actually work? Well, it's not magic, it's just math. It really comes down to avoiding the hidden costs that most investors don't even see. What you could call a constant financial drag that slowly, quietly erodes your wealth over time. Just think about all of the hidden costs of being an active investor. Every single time you trade, you pay transaction fees. If you have a manager, you're paying management fees every single year. And every time you sell a winner, boom, you trigger a capital gains tax bill. The coffee can model pretty much eliminates all of these recurring costs. It lets your money work for you, not for your broker or the taxman. But of all those costs, tax deferral is the absolute superpower here. When you don't sell, you don't pay taxes. Plain and simple. This allows the money that you would have paid to the government to stay invested and keep compounding year after year after year. It's literally like getting a massive interest-free loan to let your pre-tax money grow for decades. And this quote just brilliantly illustrates the biggest behavioral mistake that almost everyone makes. This common practice of rebalancing, selling your winners to buy more of your losers. It sounds so disciplined, right? But in reality, you're often just trimming your most successful investments, the flowers, to go fund your underperformers, the weeds. You're basically capping your own upside. The coffee can strategy completely embraces the opposite. It understands that investing has what they call asymmetric payoffs. Think about it. The most you can possibly lose on a stock is 100%, right? It goes to zero. But your potential gain, well, it's literally infinite. The entire strategy is just designed to hold on long enough to let one or two of those Xerox-like winners grow to a scale that makes all the losers totally irrelevant. Okay, so you can't just throw any random stocks in the can and hope for the best. That's not going to work. The success of this whole thing depends entirely on the quality of what you put inside at the very beginning. So how do you find these companies that are built to last a decade or even longer? Well, modern proponents use a really rigorous set of filters. First, the company needs a proven track record. We're talking at least a decade old. Second, it has to show consistent growth, growing its sales by at least 10% every single year for the last 10 years. That's a tough hurdle. And third, it's got to be highly efficient, generating return on capital employed of at least 15% in each of those 10 years. In simple terms, that just means for every dollar they invest back into their own business, they're generating at least 15 cents in profit. This weeds out all the inconsistent and mediocre companies. So, after a company passes that tough numbers test, there's one last qualitative check. Does it have a durable competitive advantage, or what investors call a moat? This is all about identifying what protects it from the competition. We're talking about things like a super powerful brand, unique technology, or an unbeatable distribution network. This is the stuff that helps ensure its long-term survival. The theory is solid, the filters make sense, but does this actually work in the real world? Beyond that one amazing story? Well, there's this fascinating fund that has basically been running on coffee can principles for nearly a century now, and this brings us to the ultimate proof and the ultimate challenge. Check this out. This is the Voya Corporate Leaders Trust. It was started way back in 1935 with a fixed list of 30 top American companies and one simple rule: they could never buy a new stock. For almost 90 years, this fund has just held on, only changing its holdings when a company merged or was bought out. And the result? This fossil fund, as it's called, has still managed to outperform its actively managed peers over the long haul. It's incredible. So, if the math works and the historical proof is right there, why doesn't everyone do this? Well, it's because the hardest part isn't picking the stocks, it's fighting your own brain. We are literally wired for action. We hate losing way more than we love winning. So we sell our best performers way too soon to lock in a doin. We feel like we have to do something. And frankly, we get bored. The real enemy of our wealth isn't the market, it's us. And that really brings us to the final critical question. The coffee can strategy is deceptively simple to understand, but it is incredibly difficult to actually execute. It requires this radical form of patience that goes against pretty much every instinct we have as investors. So the question isn't whether the strategy works. The real question is, do you have the discipline to truly and completely do nothing?